U.S. inflation, as measured by the CPI, decelerated significantly in the month of May, and by a lot more than analysts expected. Despite this, we don't think that this is going to change the plans that the Fed has in terms of interest rate cuts for the rest of this year. And in this video, I'm going to explain why. First off, let's review the headline data. The first thing we want to look at here is that all item CPI, which includes everything, increased by only 0.01% during the month of May. Now, this was a very significant deceleration relative to the prior month, where this figure was 0.31%. It was a significant surprise also to analysts that had been expecting 0.1% inflation this month. Now, the news was also good for core CPI excludes food and energy, because food and energy are volatile items. And month over month, core CPI only increased by 0.16% relative to the prior month, which was 0.29, and it was also well below forecast of 0.30. This was a pretty significant surprise. So the news was quite good. Let's get into some of the interesting details of the report. The first interesting detail in this report is that these were some of the best inflation numbers in many years. Core CPI inflation during May was so low that it ranked in the second percentile historically. It was a very strong deceleration, and it actually dipped into negative territory. In other words, we had a little bit of deflation in May. That's very unusual. It's the first time that core CPI has actually declined during the Biden administration. The other important detail, and it's an extremely important detail in this report, is that supercore, which is core services X housing, it excludes energy services and it excludes housing. It excludes energy because energy is volatile, and excludes housing because housing is lagged by about 12 to 18 months. So this supercore figure is really more representative of kind of the action that we have in the economy in terms of inflation. And we had a big deceleration, and it contributed 0.13% out of the 0.11% deceleration in core CPI. So that was really interesting, because this supercore number is the number that the Fed is most interested in for the reason that I described before. Now, having said all that, and despite the fact that these numbers are really good, I want to sound a little bit of caution here. Because when you look at these numbers closely, the deceleration in core CPI was mainly driven by very volatile items such as auto insurance and apparel. Because these items are so vulnerable, they can actually turn around from month to month. So it's not really clear yet whether the type of deceleration that we got this month in CPI is going to be sustainable or not. In conclusion, I want to leave you just here with a couple of thoughts. The first is that I don't actually think that the Fed is going to change its plans in terms of cutting interest rates as a result of this report. They had previously signaled that they need to have probably 3 good months worth of inflation that gives them confidence that the inflation rate is heading down to their target of 2% before they make any moves in terms of inflation. And I think that they can actually really afford right now to be patient for the following reason. Long-term interest rates, which are the ones that really matter in the economy, are probably going to fall. They did fall significantly today, and they may continue to fall significantly over the course of the next couple of months as long as we continue to get good inflation data. And certainly if we continue to get weak economic data, which is something that I've talked about in some of my previous videos. So if long-term interest rates are falling, that means that financial conditions are easing. That means that the Fed doesn't really need to do anything, because the market is going to be doing the Fed's work for it, so to speak. So the Fed can afford to be patient and wait and make absolutely sure that inflation is actually coming down to its 2% target before it makes a move. The other reason that I think the Fed is going to be cautious here is for the reason that I mentioned before, is that the deceleration that we saw during the month of May was due to some volatile items. So I don't think that the Fed can really have confidence yet that we are seeing a trend here in terms of sustaining lower inflation. Thanks a lot for joining. I'd like you to subscribe to my channel. Later on today, I'm going to post another video analyzing what the Fed did at its meeting today. And in addition, during the next few days, I'm going to be posting some really interesting videos, some videos that I think are going to surprise some of y'all, because it's going to deal with some more general interest issues that I think are quite interesting. So I want to invite you to subscribe to my channel. And for those of you who are part of my subscription service, I'm going to have another video where I'm going to go into the details of these numbers in today's video in a lot more detail. Thank you very much.